So let's go through this short put strategy in greater detail with our Gilead example. So what's our psychology? Well, we're mildly bullish on this. So we want to go through the step by step what we're trying to do with this strategy. Basically, we're getting paid upfront in order to ensure stocks at cheaper prices. That's ultimately what we're doing with this particular strategy. Now, if you don't want to own the shares of the stock, you choose strike prices which are further out of the money. We'll talk about that later on again. If you do want to own the shares like we do with Gilead, and we wanted to own them at 91, so that's why we chose that particular strike price. And again, as we'll show you later on, you can dictate the probability of success with this particular trade. Now, we're considered mildly bullish on the other underlying. If you were more bullish on this particular stock, you might buy the stock itself, or you might buy a call option or do some other type of call option trade. But this is it's like a high probability trade that you're placing. It's a credit trade. That means you're getting paid up front to place it. It's much better placed when implied volatility is higher, and you want implied volatility to decrease after you've sold the put. The reason is implied volatility is a major component in an option's price. So if implied volatility is high when you sell it and then it decreases, that means you could in effect buy back that option cheaper. So how did we construct the trade? We showed you how to do that. We sold the Gilead $91 30th expiry put option, and we took in $344. So what was our rationale for the trade? Well, Gilead was trading at 95.66. We have a 120 price target, but we would prefer to buy this particular share at 91 rather than where it's at. So we sold put options. Implied volatility was also extremely high when we placed the trade, and we're getting paid for agreeing to buy the shares if they fall below the 91 level. So that's a win-win for us. We're looking at a stock, we're happy to own it at 91, and now we're going to get paid to own it at 91. Yeah, we'll have more of that, please. So we got in $344 or $344 per contract. Remember, in the options market, one contract controls 100 shares of stock. So what's our risk in this? Well, technically our risk amount is if the share price of Gilead falls below 91. So technically if Gilead fell to zero, we'd have to buy shares of Gilead at 91, but that's unlikely to happen. So our risk is actually 91 minus the income we took in, which is 344. So we're risking 87.56 per share. That's only if the share price fell to zero, which is a highly unlikely scenario. What's our max profit? Well, we can only make what we took in from the trade. That's all we can make in this particular trade. The credit that we received. That's it. Our break even is equal to the strike price minus the credit received. So for our Gilead trade, the strike price was 91. The credit we received was 344. So our break even is 87.56. So as long as Gilead trades above 87.56, we're making a profit. So here's where probabilities come into it. If you think about it, Gilead is trading at 95.66. We've just told you our break even is 87.54. So that means Gilead can afford to fall loads before we have to start, thinking about a lost position. In fact, it would have to fall $8.12. And in percentage terms, that's 8.4%. So Gilead would have to fall another 8.4% in 4 weeks before we start to lose money. That's why this is a high probability trade. And you've seen from our trade, when we actually placed it, the probability was at 77%. So what's the effect of volatility? We've already talked about that. We benefit when implied volatility drops. So any drop in implied volatility usually reduces the value of the put option, which means we can buy it back cheaper for a profit. And then we have theta. And when you're selling options, theta is working to your advantage. So remember what theta is. It's just the rate of time decay in the value of an option, or in the time value of an option. And we know that theta was 8 cents. What does that mean? It means that the value of our option will decrease by 8 cents every day between now and expiry. And that's just on the time side. Of course, if the share price falls, then the intrinsic value of the option goes up. But just on the time element, this is working to our advantage in a big way. So how do you go about picking the strike? Well, if you want to own the shares, it's very simple. Just pick the strike you're happy to own the shares at. Simple as that. If it's a return-based strategy that you're using, So what we mean by there is if you're going, okay, I'm going to trade options like this and I'm actually going to look for high probability trades. I don't particularly want to get the shares. Make sure you're giving yourself probabilities of over 80%. Managing the trade. So what happens if the strike price falls below, or the share price falls below the strike? Well, if you want to own the shares, do absolutely nothing. Basically, your broker is going to sell you those shares. You're going to have them in your account after the expiry Friday. If it's a situation you don't want to own the shares, you could buy back the put option at a probable loss. And you can do that at any stage between now and expiry. That's the great thing about options. You can buy and sell them like stock. Or you can roll out the put option to the following months for a net credit. And that's where you're literally buying back the 30th of October expiry and then maybe selling it out again another month into November. And you get an even bigger credit for that. If you have any questions on this strategy, please call us. We're now going to get into profit and loss tables, and we're going to compare it to buying a stock and also using the long call strategy and see which strategy fares out best.